So at this point, you've seen how fundamentals aren't necessarily the driving factor of the market, and you've also started to understand that people are predictable. Let's understand how we can take that idea of people being predictable and turn it into something that we can use in terms of analyzing the price action of the stock. Take a look at this picture on the screen here, and you see a chart of a stock known as Caterpillar. Now, whenever you look at this, what is your first reaction when you first see it? For some of you, you may be thinking, oh, the stock sells off radically and then, kind of stabilizes and goes nowhere for a while. Some of you may be looking at it and seeing some opportunity. You might be looking at it thinking it's a little bit random. All of you are going to have a different idea about it. Whenever I look at this picture, I see a predictable opportunity of trading behavior. And specifically what I see is I see patterns of human behavior being reflected in the price action of this chart. Let me show you what I'm talking about. The concept that I want to introduce you to are support and resistance. These are the two most important words in the world of technical trading. Support and resistance. Let's define them. Support is the price point where a stock finds more buying pressure than selling pressure, and the buying pressure drives the price of the stock higher, thus creating a bullish situation. Support is going to show up on the bottom. You can think about support as kind of like the floor on a multi-story building. If you think about the floor, you can jump up and down on it and it's going to support you. The same idea is true with the price action of your stock. There's going to be a price point where there's a lot of buying pressure. There's a lot of people that think, hey, this is a good value at this price, and they're going to be buying. That will provide a floor for that stock. We'll call that support. Now, resistance is going to be the exact opposite. Resistance we're going to define as the price point where a stock finds more selling pressure than buying pressure, and the selling pressure drives the price of the stock lower, thus creating a bearish situation. So let's think about a resistance as the opposite of the floor. Resistance is going to be like the ceiling. So if you're on a multi-story building and you're jumping up and down and you keep running up and down into the ceiling, what happens? Well, eventually maybe you'll break through, but most of the time you're probably going to get a headache, right? The same idea is true with the price action of your stock. You have a stock and it keeps running up into a price point that is acting a bit like a ceiling, and every time we run into it, we get more and more selling pressure. This is the idea of support and resistance. Now let's come back over here to our Caterpillar trade and take a look here. Do you notice anything interesting about this picture? The first thing I want to pull your eyes to is, yes, it is true that at the beginning of the year, the stock was trading up near $100 a share, and now the stock sells off, but notice what happens. As we started to rally out of there, there are several price points where the stock rallied up into, and then the stock turned around and sold off. In fact, we could put a line across here, right around $88 a share. Notice what happened. Every time the stock runs up to $88 a share, something happens. Yes, there's a couple of times where the stock rallies a little bit above that before it starts to sell off, but for the most part, we get up here to about $88 a share, and the selling pressure builds and the stock turns lower. Once we had a location here in August of 2013 where the stock didn't quite make it to $88, but for the most part, there's a lot of selling pressure happening there around $88 a share. Okay, now let's look at the bottom here and notice what happens right around $82 a share. We could draw a line here and we can call this support. Notice what happens. Every time we get down here, for whatever reason, the buying pressure starts to build. It's not always exactly to the penny, but it's pretty close, right there around $82 per share. And so you can see we can draw a line across this chart, and around $88 a share, you see the selling pressure starts to build, and around $82 a share, you start to see the buying pressure starts to build. Now, understanding support and resistance is going to be very, very important to understanding how we trade technically, because support and resistance help us define trading ranges. And then we can use those limits to begin all of our entire analysis process. All right, now let's take that idea of support and resistance and the stock that's moving up and down between support and resistance, and let's assume that as long as the buyers and the sellers are buying at a predictable spot and they're selling at a predictable spot, we're going to have some sort of a predictable pattern. Well, if we've got a stock that's moving sideways between support and resistance in a predictable repeating pattern, we're going to create what we call a channel. This is a type of a trading pattern. If you look at this picture here, this is a theoretical drawing. drawing of how a channel would work, but the idea is that the stock rallies up into resistance. Some selling pressure is going to build up. It's going to sell off down into some support. Some buying pressure will build up, and the pattern will repeat over and over. Now, this is very theoretical, but in theory, it's one thing. In practice, it's very, very similar. Take a look at this chart right here. Notice what we've done. We've got kind of a theoretical drawing here. The stock sells off from resistance down into support, rallies back up into resistance, and it continues in a pattern that is somewhat predictable. Now, this again looks a little theoretical, but watch this. I'm going to just kind of make one little shift, and there's our Caterpillar trade, this exact stock we were just looking at. And so you see, we draw these straight lines for a theoretical teaching moment, but what happens is underneath it is an actual idea that in reality really shows up in the market in multiple locations. Let's take another picture here, and let's take the idea that we just had of a stock moving sideways between support and resistance, but this time let's turn it on its side just a little bit, and now we've got a stock moving between support and resistance in a predictable repeating pattern. But this time we are doing so while making higher highs and higher lows. Now, this is really, really important to understand. Take a look at this theoretical picture here. Notice each of these swing high points. Notice how they are higher than the previous one. And notice each of these swing low points, how they are higher. Anytime you've got a stock that is making a sequence of higher highs and higher lows, by definition, we have an uptrend. If we're doing that pattern, a pattern of higher highs and higher lows, while also trading between support and resistance in some sort of a predictable repeating pattern, we've got an upward channel. An uptrend is not always an upward channel, but an upward channel will always be a variation of an uptrend. Now, let's look at this in a more realistic view here. Notice we've got the same pattern that we just drew out here, sequence of higher highs and a sequence of higher lows, but we're also doing this while trading sideways between support and resistance. This is an upward channel. And so you see we've got both an uptrend happening and an upward channel. Now let's take that same idea and let's turn it on its side, but this time instead of having higher highs and higher lows, we're going to have a stock moving sideways between support and resistance in a predictable repeating pattern, but this time we're making lower highs and lower lows. Notice what's happening here. Each of these swing highs is lower than the previous. Whenever you've got a stock that is consistently making lower highs and lower lows, we have a pattern that is a downtrend. Lower highs and lower lows, by definition, constitutes a downtrend. If we're doing that while moving sideways between support and resistance, we've also got some sort of a downward channel. Take a look here. This is a more practical version of this, a little bit less theoretical. Lower highs and lower lows, this defines a downtrend, and the fact that we're moving between support and resistance helps us define the fact that we're also in a downward channel. Now, these patterns show up frequently, and so I've got the idea here that we could take a basic channel, whether it's a horizontal channel that's moving sideways, or maybe it's an upward channel or downward channel, and we could actually turn this into a very basic retirement plan. I realize it's not a huge move, but typically it's going to be anywhere from 2 to 3% of the stock maybe. On a more expensive stock, that may look like $8 or $9. On a less expensive stock, that may only look like $3 or $4, but it's still enough that we could get in while we're bouncing up off of support, and we could sell when we run up into resistance. So here's a very, very basic retirement plan, one that will pay you typically anywhere from 20 to 30% over the course of a year. And here's how it goes. We learn how to draw basic support and resistance on a chart. Then we turn around, we find stocks that are consistently trading between support and resistance, and then what do? We buy at support and we sell at resistance. Now, it's a very basic idea, it's a very basic strategy, a very basic trading plan, but it's the beginning of what we're going to start using to build out a more complicated and a more complete trading plan. So the question that you've got to be asking at this point is this real? Can I actually do this? Of course, Jeremy, you've shown me some theoretical ideas, but could we really do it? Well, let's just take a look over here. These are some real charts, not in the too distant past here. Take a look. This is John Deere. And notice what happened between May of 2014 and October of 2014. We had a top that happened, and look what happened. Sequence of lower highs and lower lows. The stock is trading in a clear downtrend. And most of the time, we are in a fairly defined range of a downward channel. This is a great example of a downward channel in a real-world situation. Notice it's never going to be quite as clean in a real-world situation as it is in a theoretical situation, but it's still the same basic principle. And so the idea here is maybe you come along, and as you're running into resistance here, you can start shorting the stock, so you can start selling as the stock is falling. And then as we start to rally a little bit, you buy, you get out of the trade, then the selling pressure comes back in, and you can sell and you can make money on the downside. We'll talk about selling short in a future class, but that's one way you could trade this particular channel. Now let's look at Disney here. This is a trade that's taken place from September 2013 up into October 2014. Just recently on this chart, you can see the trade started to break down. Once you start to break below your support level, the pattern has changed, and we're going to have to start using some different strategies there. We'll talk about those in some advanced classes, but let's look at the basic pattern that occurred here from September up into October. This is basically right at a year, and notice what happened. We had a sequence of higher highs and higher lows all the way through here, and for this entire move from September up to October, we had a bullish trend. It was an uptrend, and you can see that for the most part, we were moving in a fairly well-defined pattern between support and resistance. Let's take another example here. This is on eBay. We've actually got 3 examples here on this same chart. Look between more like December 2010 and January 2012. So about 1 year, we got a very defined support and resistance range here. Stocks moving sideways between support and resistance in a fairly predictable and repeating pattern. This is a buying and a selling opportunity. Look at what we could do here. What if we were to buy as we bounce up off of support at about $30 a share, and we sell as we pull away from resistance right around $35 a share? That's a $5 per share trading opportunity. We did one cycle there. We sell off a little bit. If we were to buy in here, it'd be kind of tight, but maybe we could buy in around $32 a share, sell at $35. The next time we could definitely do it as we bounce up about $30 a share, sell at $35. There's another $5 per share opportunity. We could do it again this cycle here, and we could certainly have done it again this cycle here. So we've got at least 4 opportunities here where we could have made $5 per share over the course of a year. That's $20 per share on a $30 stock. That's well over 50% return on your investment there. Now, as this trade got going in January 2012, we got into a nice little uptrend, and notice what happened. We have our support line clearly defined. We've got a resistance that's clearly defined here, and we've got a stock that's moving between support and resistance in a predictable pattern, and we're also making a sequence of higher highs and higher lows. Okay, so anytime you're in a trend, you want to trade in the direction of the trend. So in this case, we would not take bearish trades. We would only take the buying opportunities as we bounce up off of that support level there, and we would keep buying in the direction of that trend. Now notice what happened starting in January of 2013. We got yet into another sideways move. This time the move was moving between about $50 to $51 a share up to about $58 to $59 a share. So you've got about maybe $6 or $7 profit depending on exactly where you get in and out. And we've got several opportunities here that were fairly easy to get into and out of. Let's just call that 1, 2, 3, 4, 5 opportunities, and we'll just make this very conservative. We'll say we made $6 a share on each of those. So what is that? 5 times 6 is what, $30? So over the course of a year here, maybe a year and a half, we could have easily made another 50% or better of the value of this particular trade. So on eBay, we've had several great examples over the last couple of years on this. And the truth is, if you spend enough time looking through the market, you're going to find there's a lot of stocks that consistently get into patterns that look just like this. Now, don't deceive yourself. Not all stocks consistently trade in a channel, but this is the basic pattern that we will start to build our understanding, our broader understanding of market behavior from. So in the next section, what we're going to do is we're going to learn how to actually go into a chart that you've never looked at before and start drawing those support and resistance lines, and by the end of that section, you're going to have an idea of how you can take a chart you've never looked at and start this process for yourself, and then we'll actually move on into how to go into your charting software and do it.